Fallout from the deadly coronavirus continues to affect global markets. Our next guest says this could be good news for investors, as pandemic scares tend to be short-lived. He gives us a 20-day timeline. Joining us now is Waddell and Associate CEO David Waddell. Thank you for being here. Give us a little bit more about that, a timeline, because that's something we keep asking. We know the incubation period, according to CDC, is about 14 days. So once they get their hands wrapped around all of this, we get back to normal within 20?
Actually, based upon this market activity today, I think we got back to normal in about 20 minutes. But if you look at the movement in the interest rate complex, which to me is a little bit more reliable than the movement in the stock market complex, it usually takes about 20 days in these sort of, peripheral epidemic type scenarios for interest rates to sort of bottom and then make a case back forward. So in those cycles, and again, that goes back over, 50 years, even still, it's about a 20-day period. But given this current cycle and the somewhat diminished severity, I think that everybody feels like this virus may have, I think that timetable's been dramatically accelerated. I mean, we only came down, 4% on the S&P? And China, which is closed, but still trades through the ETF markets, down about 9%. And you see that rapid snapback in the 10-year today. So that doesn't mean it's over, but I'm not sure that this will really have the same impact as some of those larger epidemics.
David, this is not the only instance in which we seem to be seeing remarkable resiliency in the markets, right? We've had geopolitical issues, even the trade war, and the market just keeps going higher. Is that because of the Fed? Is that because of the repo operations they're doing? Is it because of easy money? What's going on?
Yes. So if we back up and take a look at the two most important charts for everybody to watch this year, one is inflation expectations, because that controls Fed action on the interest rate, the overnight rate. And then two is the amount of excess reserves in the banking system. So the QE, or not QE, whatever they want to call it, targets directly the reinflation of those excess reserves. They've pumped $400 billion into the system. $300 billion has shown up in excess reserves. Where's that other $100 billion? I don't know, but it seems to be good for the markets. Are they done with inflating those excess reserves? I don't think so. So I think QE stays online at least for the next 3 or 4 months. And I think the Fed made a mistake, and they know it. They tried to get ahead of inflation at the end of 2018. They raised rates far too far. They had to bring them back 3 cuts quickly in 2019. Now they've decided we are going to be behind the curve. So they're not going to move until they see a substantial and persistent rise in inflation. So that means no rate increases. And on the QE side, I think they still want to see bank reserves go up a little bit more. So you're going to continue to have an easy Fed, and you're going to continue to have quantitative easing, at least for the next 6 months or so. And in the background, we see some recovery in economic data. We saw some, good news in the durable goods reports today. So there's no real reason to sell down this market hard. However, I will say if we get into June and they start extinguishing QE, things could get somewhat treacherous again, depending, of course, on how much the ECB will do.
Right,
so
David, I want to bring Kathy Jones, who's on set with us, into this, because I know she has some thoughts with the capital T on this whole QE or not QE discussion. Kathy?
Yeah, so I will probably die on this hill and say that I do not believe it's QE when you're swapping, T-bills for reserves. And keep in mind, the balance sheet was flat for 4 years and the market was going up. So you don't need QE to drive the market.
The ECB balance sheet was growing.
Bottom line is you could debate it one way or another, but it seems to be expectation. So because people believe it's QE, it seems to be driving asset prices. But I agree with you, they're going to flatten this out. They're not going to do this forever. They'll either set up a permanent repo facility or they'll just have enough reserves that they don't need to do it anymore. What would your call for the market be at that stage of the game?
Well, that gets challenging, right? Because it goes back to what's the appropriate level for interest rates. So if we're in a sub 2% inflation world, and you look at where, things are for yields, that's a 50 PE if you do the inversion. I don't think that's appropriate. But if you look at market peaks in the past, the trailing PE ratio has been 20 or above. So there's no real reason for that ratio to collapse. And as long as you've got continued economic growth and therefore continued creation of profits and the reinvestment of those profits through buybacks or whatever means, there's stability beneath the market. So there's got to be an exogenous event. Usually it's a credit event. That usually occurs because inflation's ticked up and the Fed's gotten nervous, and so they tighten conditions, and that breaks something. I mean, we're clearly creating an environment where something ultimately will pop. It's just that could take a while, given the 2% inflation, 2% interest rate, 2% GDP growth world we're in.
All right, David Waddell is the CEO of Waddell & Associates. Good to see you.
Good to be with you.